Hello everyone. Inflation is down. Fed raises interest rates. What is happening? The market is a bit down. Let's dive in. So, as we all know, the inflation for November came in at 7.1, which was less than the market expected at 7.3. I think that's really good. Inflation coming down faster than expected. But the key trend is that inflation is coming down. Also, the Fed increased rates from with 50 basis points with 0.5%, and now the target range is between 4.25 and 4.5. Now, I really like this FedWatch tool from CME, and there's gonna be the next meeting is gonna be in 48 days, and the market is predicting only a 25%, no, not 25%, 25 basis points hike next at next meeting, which is quite interesting. I think from the dot plot of the members of the committee, they are expecting the rate for 2023 to reach somewhere like 5.1, something like that. So somewhere between 5 and 25 basis points. Which is pretty high, I gotta say. I like it. Just bring the inflation down. That's all we want. So first of all, let's look a bit at the inflation. So for November 2022, consumer price index was cooler than expected. Blah, we already know that. So CPI jumped 7.1, lower than expected, and the Fed is we know that the Fed is raising interest rates to cool demand, which of course they should. But yeah, overall inflation is 7.1, but food inflation is still notably high. I mean, if you look at eggs, 50% year over year, that's a lot. Eggs, butter, lettuce, cereals, bakery products, probably this is also bread. They are way higher than 7.1%. So keep that in mind. I think what dropped a lot, I guess, I know that used cars dropped a lot in the last year. So there's that. And people probably stopped spending too much on smartphones and televisions, although these are hedonic adjustments. So basically, TVs and smartphones are getting better with every year, but you're buying them for the same price, and the Fed says, well, it's cheaper. I don't know about that. So yeah, average inflation 7.1%. All items less food and energy, as though we can live without food and energy, 6%. It's quite interesting how they care more about this. I think this is the core CPI, because yeah, you're excluding the volatile part, but interestingly, it's volatile only on the way up. Right, so yesterday, I believe, the Fed raised the interest rates by 50 basis points, and yeah, along with this increase came an indication that the Fed will keep rates higher through next year with no reductions. But take this with a caveat. If there's gonna be like a big market breakdown next year, be sure they're gonna lower interest rates to zero again, most likely. If nothing breaks, yeah, but most likely something's gonna break. How do you know that? Well, we can take a look at the yield. This is the 10-year treasury yield minus the 2-year treasury yield, and we can see that it has been inverted since July. So it's like 4 months. We're having an inversion on the yields, and that's usually not good, because if we look at some history, I mean, let's go to a 1-month range. What happened before the great financial crisis in 07-08? Well, the yield inverted. Dot-com bubble, the yield curve inverted. 90s, 88, 89, 1990, right? Yield curve inverted. So usually in 12 to 24 months after the yield curve inverts between the 10 and the 2s, you're gonna have a recession. So and actually not usually. I think in the last 10 stock market crashes, you had the inversion of the yield curve predicted 9 out of 10. So let's say you have a 90% probability that we're gonna have a recession in the next, call it 18 months. Now, 18 months is a lot, it's 6 months longer than 1 year, so we might not have a recession in 2023, but be prepared for one. You're never gonna know. And as we can see, like everything is in the red today. So it's in the red because the Fed raised interest rates, and they were hawkish. They said they're gonna keep interest rates high. And yeah, markets do not like that. They did not like that. So yeah, even our precious metals, gold and silver, they also are down for today quite a lot, right? We can see gold is down 1.5%. Silver is a lot more volatile, of course, 3.5%. I'm actually hoping silver does something like that, and this would be a really great opportunity to buy. So why not? I would love to buy some silver in this $20 per ounce range, which I'm really gonna do. You probably don't, some of you may know, but very few people watch my channel because I'm very small, right? But my strategy is to be patient with silver and basically wait for the RSI to get in this oversold area below 30. That's when I'm usually buying silver. It makes it's a process. It's not a perfect process, because I might buy here, right? I'm buying here and the price might go lower, but still buying here is a lot better than buying up here, right? You can save $2 or $3 per ounce, which is savings is savings, right? So yeah, that's my strategy with gold, silver, even stocks, right? Even though for stocks, I'm also trying to evaluate if a company is undervalued or not. But I am still looking at charts. Like, let's say I'm finding out that Intel is a really good company and it's below my target range. I'm still looking at charts. I'm not gonna buy on a pump. I'm just gonna wait for the market to cool down and probably buy here, right? But even if I buy here and it goes down, it's still better than buying here because I know that over the long term, if the company's fundamentals are good, the stock is gonna go up or they're gonna pay a very high one-time dividend. You never know. So yeah, uh, we can also look at some inflation chart to probably visualize the drop in inflation that we had over the last few months. I think it's US inflation, something like that. US EFYY. Well, I don't know it right now, but yeah, I don't know the exact ticker number for the inflation and inflation. No, inflation. Economy. Right. US interest rates year over year. This is the one. Okay. So this one goes back quite a lot, I believe. Yeah. This is the 80s when we got about 15% inflation year over year. And since then it went down. Volcker raised interest rates a lot higher than Powell to calm down inflation, and it kind of worked. This is a great financial crisis. We had a bit of deflation because negative inflation means that prices are actually going down on a yearly basis. And we had a decade, more than a decade of really, really low inflation, which is nice overall, but it's still bad. Ideally, but we do not live in an ideal world, inflation would be 0%. That would be ideal, in my opinion. I'm not sure if that's the right opinion, but that's what I believe. And this is where we are now. Current inflation is 7.1% in the United States, of course. In Europe is a lot higher. And it's kind of stagnating. So we actually have stagflation in Europe. But yeah, the trend is our friend right now, right? We like this trend. We would like inflation to go down. And there's two ways inflation goes down. Either in a financial crisis, or we're gonna have some sort of a soft landing, Fed raising interest rates, maybe won't break anything. That would be the preferred way, but usually the Fed breaks something. So we would like this to continue going lower in an orderly fashion and maybe start plateauing once it reaches 2%, because that's the target of the Fed. So that's our target as well. Alright guys, thanks for watching, and I'll see you in the next video.